Paying yourself the wrong way can cost you thousands of dollars in taxes every single year. Salary, dividends, or both. This is one of the most important and most confusing decisions Canadian business owners face. In this video, I'll break it down so it's crystal clear. By the end, you'll understand the difference, the tax impact, and how to decide what's best for you. And don't worry, if this topic has ever felt overwhelming, you're not alone. Most of the business owners I talk to ask this exact same question. This decision affects much more than just your taxes. It impacts your retirement savings, it changes whether banks will lend you money, and it even determines what government benefits you might qualify for. I work with Canadian entrepreneurs every single day, and this really is one of the top questions I hear. How much should I pay myself in what way? So let's slow it down, keep it simple, and walk through this step by step. First, the basics. A salary is just like being your own employee. You run payroll, you get a T4 slip, and for the company, salary is an expense. That means it reduces the company's taxable income. Dividends are different. They come out of after-tax corporate profits. They're reported on a T5 slip. And dividends are not an expense, so the company doesn't deduct them. So both get cash into your pocket, but the path and the tax treatment are very different. Be careful though, you cannot pay dividends if your retained earnings balance is in a negative position. If this sounds technical, don't worry. Think of it this way. Salary comes off the top and dividends come from what's left over. And that brings us to how the tax system actually looks at the two. Canada uses something called tax integration. The idea is simple. Whether you take salary or dividends, the total tax, corporate plus personal, should be roughly the same. So here's the reality. It's not perfect, and as always, it depends. Different provinces and different income levels can create small gaps. At $80,000 to $100,000 of income, the difference may only be a few $100s, but at higher income levels, it can swing into the thousands. That's why there's no permanent winner. It's something you need to review every single year. And I get it, nobody likes the idea of rechecking every year, but the truth is this small step can keep a lot more money in your pocket, and I know you care about that. Now, let's look at where salary and dividends really differ. And here's where the decision has a long-term impact. Salary requires CPP contributions from both you and the company. Yes, it feels like a tax today, but CPP is actually a pension. 95% of Canadians over 65 collect CPP, and most rely on it to fund their retirement. Salary also creates RSP room, and 18% of your earned income becomes your RSP contribution limit. No salary means no RSP room. And salary can give you access to programs like parental leave or employment insurance, if you're opted in as a shareholder employee, which is a topic for its own video. Dividends don't give you any of these. No CPP, no RSP room, and no EI. It's more cash today, but fewer retirement benefits later. And that's where a lot of owners get caught. They love the flexibility of dividends, but they forget about the long-term trade-offs. So let's balance that with another angle, your day-to-day cash flow. Salary is steady and predictable, and that's what banks love when you apply for a mortgage or a loan. Dividends are flexible. You can wait until the end of the year, see your profits, and then decide what to declare. That flexibility is huge if your income goes up and down. So it's not just about tax, it's also about how your income looks on paper when you need financing. And while we're talking about the bigger picture, let's look at how this affects your company's tax position. Salary lowers your company's taxable income, and that can help keep profits under the small business deduction limit, which saves corporate tax. Dividends leave profits in the company, and that's useful if you want to reinvest or keep funds inside the corporation. Family planning matters too. Salary works if your spouse or kids actually work in the business, and dividends can sometimes be paid to adult family members. But CRA's tax on split income rules are strict. If you don't meet them, the tax hit is massive. I know, that one feels a little complicated, but the main point is this. Salary and dividends can be powerful tools for family planning if you use them properly. Now, of course, whichever option you choose, there is paperwork. Salary means payroll, remittances every month, source deductions, and T4 slips at year end. It's more admin. Dividends are simpler. You declare it, record it, issue a T5 slip, but don't assume it's casual. CRA expects proper records for both salary and dividends. Sloppy books are a huge red flag. So with all that in mind, how do you actually decide what's right for you? All salary works if you want RRSP room, CPP contributions, and stable income for borrowing. And all dividends are lean and simple, no payroll headaches. That works if you value flexibility and don't care about CPP or RSP room. But for many business owners, the best approach is a blend. Take enough salary to create RSP room and max out your CPP, and then top it up with dividends for flexibility. And remember, your mix should change as your business grows. What makes sense at 100,000 in profits isn't the same at 500,000 or 5 million. I always tell clients, do not set it and forget it. Review your approach at least every year. Now let's go over some of the mistakes I see far too often. Here are the traps to watch out for. Only dividends and you lose retirement benefits. Only salary and you miss corporate tax deferral. Dividend-only income is harder to qualify for a mortgage, and never adjusting your mix as things change. And one more note, salary and dividends aren't the only way to take money out. You can also reimburse expenses, use shareholder loans, or charge management fees, but salary and dividends are the two biggest options that most owners lean on. All right, so let's do a quick recap on your bottom line. For salary, it reduces your corporate taxes, it builds RRSP room and CPP retirement income, and it's predictable. Banks love it. There is more admin though, payroll remittances, T4s, and all that fun stuff, but it's less flexible. For dividends, they're simple, no payroll or deductions. They're flexible, declare it when your profits are clear, or keep cash in the company for reinvestment. There are no CPP, there's no RSP rooms, and it can't affect your loan approval. And it's not possible if you have no retained earnings. And for most business owners, a blend works quite well. Enough salary for RSP and maxing out your CPP, and then you can top up with dividends for flexibility. You should be reviewing your mix every year as your business grows and the tax rules change. There truly is no one-size-fits-all approach here. The right answer depends on your goals and your income, and that's why you should review it every year with your accountant. If you want to get a better understanding of what might work best for your situation, take a look at the playbook down below in the description. It's Canada specific and will help you decide the mix that keeps the most money in your pocket. And if you found this video helpful, you'll probably also like this one.